Oil above $110 and an AI wobble in big tech are pulling equities between stagflation risk and an exhausted rally. Welcome to vTalkInsight, Equity Pulse Daily for April 29, 2026, where we connect today's macro shocks and company news to what is really driving equity markets. The dominant macro story for equities right now is the intensifying energy shock. Brent crude has pushed above $110 a barrel after 7 straight daily gains, as blockades around the Strait of Hormuz and a U.S. naval squeeze on Iranian exports restrict flows through one of the world's key shipping choke points. Floating storage is building across the Middle East, and exports from producers such as Kuwait and Iraq are being held back, while refiners report paying well above benchmark prices because prompt barrels are so scarce. Iran is reportedly within only a few weeks of hitting its storage limits, which raises the risk of forced production shutdowns if exports remain constrained. That dynamic increases pressure on all sides to find a way forward in nuclear talks, yet uncertainty around U.S. policy and the lack of a clear exit strategy are keeping geopolitical risk elevated and volatility in energy markets high. Base case projections now see Brent around $90 by year-end, already far above pre-conflict assumptions, and if key shipping routes stay disrupted, some scenarios point to $120 to $135 as demand destruction collides with visible physical shortages. The macro implication is a rising stagflation risk, especially for Europe and parts of Asia that are far more reliant on imported energy. Forecasts for global and U.S. growth have been cut, while inflation projections are being revised higher, including a jump of more than 140 basis points for Europe, and analysts warn that sustained high oil prices could tip weaker regions into recession if shipping disruptions persist. In the U.S., rising gasoline, jet fuel, and diesel prices are starting to offset earlier fiscal support for households, squeezing disposable income and raising costs for fuel-intensive sectors such as airlines, freight, and chemicals. On the supply side, the United Arab Emirates' decision to leave OPEC from May adds a new layer of uncertainty. It follows earlier departures by Angola and Qatar and removes a key diplomatic player from the cartel, raising questions about OPEC's long-term cohesion, even though near-term volumes remain constrained by logistics and security risks. At the same time, U.S. crude and refined product exports are running at capacity, domestic inventories are being drawn down, and strategic reserve releases are increasingly seen as a necessary tool to manage tightness. For equities, this backdrop tends to support energy producers and integrated majors while pressuring energy-intensive industries, and it keeps inflation and bond yields front and center for valuation multiples across the market. Against that energy backdrop, the interest rate picture remains a source of tension for equity valuations. The Federal Reserve is facing headline inflation stuck above its 2% target, with policymakers emphasizing the cost of living squeeze on lower-income Americans as a reason to keep a firm focus on price stability. Despite political pressure for early cuts, there is no internal consensus for easing, and even traditionally dovish voices are taking a wait-and-see stance, pointing to tariffs as a key driver of recent excess inflation that may fade only gradually. Kevin Warsh's potential confirmation as Fed chair adds another layer of uncertainty to the medium-term reaction function. He has stressed the need for clearer separation between monetary and fiscal policy and highlighted inflation risks, yet his latest remarks have sounded more moderate than his earlier hawkish reputation, and some research still assumes around 50 basis points of cuts before year-end, conditional on data and geopolitical developments. Even so, long-term U.S. Treasury yields are expected to grind higher as term, inflation, and growth premiums rebuild, with many seeing the 10-year yield as still too low relative to fundamentals and warning that a sustained move above roughly 4.6 to 4.75% could become a breaking point for equities. In Japan, the Bank of Japan has held off on an immediate hike but delivered a more hawkish message, with a 6-3 vote split, an upgraded inflation forecast to about 2.8% and a growth downgrade to near 0.5%, underscoring stagflation risk. Markets now see a path for Japanese government bond yields to rise toward 1.25% to 1.5% if geopolitical risks ease, while long-dated yields in the U.S., Germany, and the UK are retesting recent highs. Dealers have built their treasury inventories to the largest share since the global financial crisis, signaling strong demand for safe assets even as risk assets trade near recent highs, and this mix of higher real yields and modest volatility keeps pressure on stretched equity multiples. The other major axis for equities is the AI-driven tech complex, which remains the center of both index strength and emerging vulnerability. U.S. equities, and the S&P 500 in particular, are still up roughly 13% from recent lows, but that performance is increasingly concentrated in technology, and especially semiconductors. Chip makers now make up around 14% of the index, roughly twice their share at the peak of the early 2000s tech boom, and sector prices recently traded about 40% above their 200-day moving average, a level last seen at that cycle's top. Much of the recent margin expansion for the S&P has come from semiconductor companies, whose margins have climbed from around 30 to the mid-40s, which leaves the broader index more sensitive to any slowdown or derating in this group. In recent days, cracks have appeared around one of the emblematic names of the AI cycle, OpenAI. Reports indicate that OpenAI has missed internal targets for sales and active users, raising questions about its ability to finance massive infrastructure spending and its long-run competitive position. At the same time, competitors such as Anthropic are rapidly gaining ground and reportedly generating around $20 billion in annual revenue, while Google's Gemini platform continues to chip away at ChatGPT's market share, which has dropped sharply over the past year. Layer on top a high-profile governance dispute, including litigation involving Elon Musk and uncertainties surrounding a potential IPO, and the narrative around a single dominant AI platform is being challenged. The equity market has reacted swiftly to these developments. AI-linked stocks including Oracle, Nvidia, Broadcom, and AMD have come under pressure, with AI infrastructure names broadly weaker as investors reassess near-term growth and spending assumptions. The Nasdaq 100 just saw its largest gap down at the open in about a month, and options markets are pricing elevated earnings event risk, particularly for the mega-cap tech and semiconductor names that have led the rally. Given how stretched positioning had become, this looks more like a sharp positioning and expectations reset than an outright collapse in AI demand, but it underscores how sensitive high multiple names are to even modest disappointments in revenue, users, or guidance. Beneath the headline volatility, several indicators still point to powerful underlying AI infrastructure demand. GPU rental prices remain elevated and supply is tight, suggesting that appetite for compute continues to outstrip availability, even as equity prices for some chipmakers retrace. Many of the largest AI infrastructure commitments are structured as letters of intent or milestone-based agreements rather than immediate take or pay contracts, which means revenue realization for semiconductor and hardware vendors may be more gradual than some of the most optimistic scenarios implied. Yet medium-term projections for firms such as Broadcom, which is expected to generate around $100 billion in AI-related revenue by 2027 from customers including Google, Anthropic, OpenAI, and Meta, and for memory players like Micron, still suggest a long runway for demand tied to data center and AI workloads. The broader AI ecosystem is also diversifying beyond a handful of early winners. Cloud providers such as Amazon Web Services are regaining momentum through custom silicon like Graviton and Trainium and platforms such as Bedrock, while overall demand for cloud infrastructure and AI compute remains strong for names including Amazon, Microsoft, and CoreWeave. Alphabet is seen as reasonably valued relative to its renewed revenue growth, margin expansion, and strategic AI positioning, even after a strong run, and many expect monetization to broaden across search, cloud, and productivity tools. Oracle, for its part, continues to highlight robust demand from OpenAI with a very large cloud commitment, although that also creates meaningful concentration risk for its growth profile. All of this points to an AI theme that remains structurally intact, but with leadership becoming more contested, greater dispersion within tech, and a market that is far less willing to forgive execution missteps at current valuation levels. Outside mega-cap tech, sector and stock-level signals show a market that is rotating beneath the surface. Energy stocks are clear beneficiaries of the current environment, with BP a standout example. BP has delivered a strong first-quarter earnings beat driven by exceptional oil trading profits and minimal exposure to Gulf of Hormuz production risks, helping its shares outperform European energy peers by around 20% since the latest geopolitical flare-up. Energy names more broadly are leading European indices as investors look for a hedge against volatility, while Shell's acquisition in Canada underlines a preference for politically stable, long-life assets that are less exposed to shipping disruptions. By contrast, higher jet fuel and diesel prices are already biting into travel and transportation. U.S. airlines are beginning to trim full-year guidance and cut capacity, proactively removing unprofitable routes as they anticipate that higher ticket prices will eventually weigh on demand. Historically, disciplined capacity cuts have helped support airline share prices by avoiding destructive fare wars, but the near-term message is one of pressure on volumes and margins. Booking Holdings provided an early warning sign, missing expectations on gross bookings and seeing its shares drop more than 8% after hours as Middle East conflict and rising fuel costs hit travel appetite and profitability. Consumer-facing names tell a more nuanced story. On one side, companies such as Coca-Cola, Starbucks, and Visa have reported better than expected earnings, pointing to resilient spending and effective pricing power. Coca-Cola beat sales forecasts by combining price increases with a shift towards smaller package sizes. Starbucks raised its full-year comparable sales and earnings outlook on the back of strong U.S. same-store performance, and Visa's results highlight robust payments activity despite broader macro uncertainty. General Motors also lifted full-year guidance after a strong quarter and backed that confidence with about $800 million of share repurchases at $75 per share, even though it continues to face significant cost pressures from raw materials and logistics. On the other side of the consumer ledger, stress indicators are flashing amber. Auto loan delinquencies and charge-offs have climbed back to pre-crisis levels, with an estimated 30% of cars now worth less than the outstanding loan balance, and lower-income households are increasingly turning to wage access products and pawn shops for liquidity. Even with larger tax refunds this season, many pawnshop customers are reportedly using those funds simply to pay down loans and cover basic expenses, rather than to increase discretionary spending. In logistics, United Parcel Service is underperforming after merely maintaining guidance, especially in contrast to FedEx, which recently upgraded its outlook, underlining how equity markets are rewarding clear positive revisions and punishing anything that looks like stagnation. Financials and industrials add another layer of dispersion. Large banks such as JP Morgan and Morgan Stanley are generating strong profits, particularly in fixed income trading, and ongoing deregulation efforts are expected to free up more capital that is likely to flow into share buybacks rather than aggressive loan growth. European banks appear less exposed to credit risk than in past cycles after years of slower lending and more diversified revenue streams, and new regulatory proposals should make it easier for them to compete in trading businesses. Barclays, however, illustrates the mixed picture. It delivered solid equity trading but weak fixed income performance and took a notable charge tied to a collapsed lender, prompting tighter lending standards for smaller, riskier companies even as it completed a major U.S. consumer transaction and reiterated full-year targets. In private credit, strains are most acute in software-heavy deals struck at peak valuations with high leverage in 2021 and 2022, yet investment-grade private credit catering to insurers remains comparatively resilient. Among industrials, Nucor continues to outperform by keeping steel prices stable, broadening its product mix and benefiting from reduced Chinese imports, whereas Cleveland-Cliffs is weighed down by higher debt, union costs, and weak auto demand. All told, correlations across equities are low and dispersion is high, with index-level calm hiding very different stories across sectors and individual names. Stepping back, global equities are trading at the intersection of three powerful forces. A tightening energy market is pushing inflation and rate expectations higher. Central banks are signaling patience with only a tentative path toward modest easing, and the AI-driven tech leadership that has powered the rally is going through a volatile but so far selective reset. At the same time, sector-level earnings and credit data show a bifurcated landscape. Energy producers, select industrials, and some consumer franchises are still posting strong numbers, while travel, parts of healthcare, weaker banks, and pockets of private credit are starting to feel the strain. From here, the key signals to watch are the path of oil prices and inventories, long-term bond yields around the stress thresholds flagged for equities, upcoming hyperscaler and semiconductor earnings and AI capex plans, and any further cracks in consumer or private credit quality. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.